Good morning, everybody. It's 9 o'clock, and I want to welcome you here at SAFE in Frankfurt. We have a prominent guest today, Thomas Kroen, from the IMF team that has been working on the current World Economic Outlook, which has been published in October under the title Policy Pivot: Rising Threats. And it addresses basically the global economic situation and tries to assess various aspects of great importance, particularly of great importance as we speak today, where we have significant policy changes, not only in the United States, which have global repercussions, but also in Germany. So welcome, Thomas. Thomas is an economist at the IMF. He has studied early on in Mannheim, Germany, and then went to US for a PhD at Princeton. So I'm very glad you are here, and you will lead us through one particular chapter of your report, which deals with inflation and inflationary experiences. And we will then try to discuss various issues. I want to invite everybody in the audience to put up questions in the chat, which I will take up and use for broadening our discussion. Most of Thomas' presentation will be on chapter 2, but there are other chapters in this report which we may also talk about a little bit. One is on global prospects and policies, and the other one on understanding the social acceptability of structural reforms. So both important policy issues at the current moment as well. Thomas, the floor is yours.
Thank you very much, Jan, and thank you very much to everybody at SAFE for inviting me and for hosting this presentation. So I'm going to present today chapter 2 of our recent World Economic Outlook, and the great tightening lessons from the recent inflation episode, which is, as you can see, a big team effort from a large team that was involved, and that's behind this chapter. Broadly, the presentation will be structured in 3 steps. We'll first ask what happened and what describes the inflation dynamics that we've observed across a range of countries in the last 4 years, and what was the contribution of different types of shocks or policy settings to these dynamics. The second part of the presentation is going to discuss the response of monetary policy and its transmission. It's going to ask whether there is evidence that the response and transmission were potentially different this time around. And the third part of the presentation asks, from a more forward-looking manner, what lessons can potentially be drawn for monetary policy in a world where sectoral shocks could be more frequent. Think, for example, of climate shocks or shocks from geoeconomic fragmentation that may introduce more frequent sectoral shocks. So the chapter asks, in the modeling exercise there, what structural characteristics of different sectors could shape the policy response. And at a time where a number of central banks have either started or are in the process of starting reviews of their monetary policy frameworks, the chapter asks whether there is a case for modifying monetary policy frameworks. So let me perhaps jump right in. First sort of part is going to document a set of stylized facts about the recent inflation dynamics across advanced economies, emerging markets, and low-income countries. Starting in 2021 and then in 2022, inflation increased to levels that were unprecedented relative to the prior period. Inflation that peaked somewhere around 8% on average in advanced economies and emerging markets, and at higher levels in low-income countries, and which then, over the course of 2023 and 2024, has been coming down again. And a significant part of this inflation surge has come unexpected. Looking at inflation forecast errors on the right-hand side, 2021 and 2022 saw positive inflation forecast errors, so inflation exceeding prior expectations. On the disinflation, during the disinflation of 2023 and 2024, parts of the disinflation also occurred faster than initially anticipated. So the next couple of slides will delve on some of the sectoral dynamics underlying the inflation dynamics that we observed. One, there were initially, during the pandemic, amid lockdowns, other pandemic restrictions, was a rotation of demand from services into goods, as the consumption of some services, think of going to restaurants, was much more difficult at this time. And inflation in the goods producing sectors took off first relative to pre-COVID averages, while it took a longer time until inflation became more broad-based and also rose in services sectors. More recently, services sector inflation that has remained somewhat more sticky, however, relative to goods inflation, that has been coming down faster. Some of these dynamics, also looking across different regions around the world, have been shaped in particular by food and energy prices, with food prices particularly important in sub-Saharan Africa and the Middle East and Central Asia. In Europe, energy prices in particular, they were an important driver of inflation dynamics. And zooming in a bit more detail on the energy side, when separating sectors across their energy dependence, one can see that inflation in more energy dependent sectors, and this is for a range of countries, increased initially and started before the Russian invasion of Ukraine, while it took more time until inflation became more broad-based and also started rising in sectors that have lower energy dependence through their supply chains. A related characteristic is a sectoral price flexibility. Some sectors are able to reprice faster than others. We saw similarly inflation in more price flexible sectors, which includes some of the more energy dependent sectors, but there's some independent variation as well. Inflation of those high price flexibility sectors that rose initially, while it took longer for inflation to also increase and to become more broad-based in those low price flexibility sectors. So looking at the economy overall, given these inflationary shocks, looking at inflation expectations, we observe that long-term expectations across both advanced economies and emerging markets remained fairly stable and well anchored. But short-term expectations that initially increased and then over the past 18 to 24 months have been coming down again. And that is partly been mirrored in wage developments. So on the right-hand side, we compare nominal wage growth to the levels of CPI inflation. You see that prior to COVID, there was some positive real wage growth in a number of countries. As inflation started surging, inflation initially exceeded nominal wages, so real wages fell. Recently, there's been a period of catch-up with nominal wage growth exceeding inflation. And that is very much in line with wage dynamics around previous inflationary episodes, something the World Economic Outlook last year delved into in more detail. So then asking, what does this mean for some of the trade-offs and for monetary policymakers? The chapter looks at developments around the Phillips curve, so the relationship between the output or unemployment gap and inflation. Prior to COVID, so in the 2010s, Phillips curve, the blue line here on the left-hand side, and this is the empirical Phillips curve, so just raw data, was relatively flat. While in the post-COVID period since 2020, the Phillips curve has both shifted up and has steepened across a number of countries. And to get a bit more at the cross-country pattern, on the right-hand side, the chapter compares the change in the slopes of the Phillips curve across a range of countries. Technically estimating two Phillips curves, country by country, one prior and one after COVID. And then the chart reports the changes in the slopes of the Phillips curves across a set of advanced economies and emerging markets. So Phillips curves for core inflation, or price Phillips curves, that have steepened across a broad set of countries, perhaps, but not quite clear, perhaps somewhat stronger in goods than in services, but the evidence weaker there. And wage Phillips curves in green that have steepened much less, which the chapter interprets that the inflation dynamics that were observed were not primarily driven by shocks to the labor market, by shocks that originated elsewhere. And that's how the model is going to rationalize them. Using a slightly richer version of this model, you can do a decomposition of inflation dynamics across different sets of countries. So perhaps 4 points worth highlighting. First, long-term inflation expectations, as we also saw earlier, remain very stable. That's a dark blue component, and so little contribution to the recent inflation dynamics. Second, in the United States, very tight labor market has been contributing to inflation dynamics. That's the red component, basically mirroring tight labor market with elevated vacancy to unemployment ratios. Third, in other advanced economies, energy shocks played a more prominent role. In light blue, with the initial energy shocks. And then those shocks passed through over time and through the production network into more broad-based inflation. That's a green component in the middle chart. So initial energy shocks and their subsequent pass-through as important inflation drivers. Fourth, in emerging markets, the contribution of import prices that's summarized partly in the yellow component of the bars, that was more important. That also includes some exchange rate effects. Now, given these inflation dynamics, the second part of the chapter tries to delve into the monetary policy reaction and its transmission. And it's going to attempt a comparison with previous inflationary episodes that may share some similar characteristics. In terms of the monetary policy reaction, you can see on the left-hand side, real policy rates across many countries started tightening in 2022, in some cases even earlier. And then even as central banks reached the peak of their hiking cycles or tightening cycles, as inflation expectations, short-term inflation expectations continued coming down, that also provided some additional increases in real policy rates. And looking across countries, the right-hand side chart, it zooms in across the economic conditions at liftoff for different countries. We observe that some emerging markets started tightening somewhat earlier than the United States or the Euro area. So some emerging markets that started tightening in 2021 already, when inflation was already increasing, and in some cases output gaps that had already turned positive. So the next 2 slides are going to attempt a comparison of this monetary policy response with prior episodes. And we're going to compare the post-2020 cycle to a previous episode of commodity shocks, so to the 1970s, where commodity shocks, particularly around oil, contributed substantially towards inflation dynamics. Of course, it's going to be an imperfect comparison, as monetary policy frameworks have evolved since the 70s, and also inflation expectations may be more anchored now. The chapter tries to get some evidence for that, and that may also change when policymakers, or what the headroom is for monetary policymakers in terms of setting monetary policy. So basically what we're going to do on this slide, we're comparing the post-2020 inflation episode on the right-hand side to some of the inflationary episodes of the 1970s that we call resolved episodes. Those are episodes where inflation returned to within its prior level within a couple of years. And looking just at the monetary policy tightening in those resolved inflation episodes of the 1970s, so the blue lines, you can see that real rates tightened faster in those resolved episodes of the 70s as compared to the most recent post-2020 episode. Now, keeping the right-hand side the same, but looking at the unresolved episodes of the 1970s, where inflation remained elevated above prior levels for a prolonged period of time. Here, the pace of monetary tightening in those unresolved episodes of the 1970s was significantly slower when we look in particular at the tightening of real rates as compared to the most recent episode. So perhaps the tightening of central banks in the post-2020 episodes, it falls somewhere in between the resolved and the unresolved episodes of 1970s inflation. Of course, some potentially important differences, in particularly around the anchoring of inflation expectations, which may be more anchored nowadays, and that may provide central banks with more room to maneuver. Given this monetary policy response, the chapter also asks, what was the transmission of monetary policy into prices and into the economy overall? So here we're basically comparing transmission of monetary policy or a 100 basis point monetary policy shock into consumer prices for a range of different different tightening cycles. On the right-hand chart, if you go country or currency area, country by country, for each country on the right, we start with more tightening cycles more in the past. The most rightward one for each country or currency area is the most recent one. Overall, the coefficients broadly comparable, especially when looking at the confidence bands, quite a bit of overlap in most regions, suggesting that at least on a high level, do not see evidence that the transmission of monetary policy tightening into consumer prices, we do not see evidence that this changed significantly and across the board in 2021 to 2023, this inflationary episode. And so given these results on transmission, the third part of the chapter tries to ask what lessons can potentially be drawn for monetary policy in a world that may have more frequent sectoral shocks. So there's going to be one or two technical slides to try to get at some of the mechanisms of the model we use to simulate, and then a few results on monetary policy, first regarding the current inflationary episode, and then a forward-looking simulation if we had perhaps a different configuration of sectoral shocks. The model is going to be multi-country and multi-sector, so the model can study interactions between different countries and potentially between, for example, monetary policies and the path of monetary policy in different countries. It's a multi-sector model. The empirical version is going to have currently 11 sectors. That's going to allow to study the transmission of an inflationary shock in one sector across the production network or across input-output linkages into more broad-based inflation. And the model features a potential element of nonlinearity or of sectoral constraints, which the model is going to determine whether those were binding or not during this episode. You can think of these sectoral constraints. The right-hand chart tries to illustrate the intuition behind them. With a standard demand and supply curve, the black lines, relative to that, the sectoral supply constraints introduce a vertical part to sectoral supply, the blue line. Once a sector is at its sectoral constraint, any additional increase in demand is going to be reflected in prices and inflation. But due to the capacity constraint, output cannot expand further. You could think of these capacity constraints as arising, for example, in the energy sector, or it could be due to disruptions to shipping or international supply chains, some of which we have observed in the recent COVID period. But more broadly, the model is going to determine endogenously whether those constraints were binding at different points in time or not. And that's what's going to determine the overall, it's going to inform inflation dynamics. This perhaps illustrate just on a technical level what these potentially binding constraints at the sectoral level introduce. So we try to show on the left-hand side, and this is a simulation exercise. We'll go to the data on the next slide. If we vary the level of sectoral constraints that bind across economies, going from the most left towards the middle of the chart, as more and more sectors come up against their sectoral supply constraints, the Phillips curve steepens as these sectors that are up against their constraint cannot expand output further, but inflation is rising in those sectors. And that is propagation across the input-output network. Adding on the right-hand side, just briefly, relative shocks to demand across different sectors. So some sectors experiencing stronger demand and others weaker demand. Could think initially during COVID, demand rotated towards goods, perhaps stronger goods demand, but weaker services demand. Such relative demand shocks can as well introduce shifting up of the Phillips curve. But let's look at some of the data and what the model estimates. And just remind in terms of the estimation, the model is going to determine, based on the data, on the observed data, whether sectoral constraints were binding or not at different points in time. If we look at the contribution of these sectoral supply constraints when estimating the model for the recent inflationary episode, the chapter finds that supply constraints contributed to inflation, initially perhaps up to 2 to 3 percentage points, initially more in goods and energy. This is here for the United States. And later on, as we can see, also more of a contribution from services supply constraints as well, the red contribution. At the same time, those weighed negatively on output. Right-hand side shows the impacts on GDP. That's on the level of GDP, not on the growth rate. And there as well, those weighed negatively. For the US, some of the other shocks, and those are the gray bars that basically contain all of the other potential shocks, partly outweighed the impact of those supply constraints. And that, when looking at the economy overall, has potential implications for the trade-offs for monetary policy makers. Looking at the blue line, the observed path of US monetary policy. If the US had tightened earlier tightening would have implied faster, lower inflation, but also a larger cost to output. At the same time, if there were none of these sectoral bottlenecks that were binding, disinflation would have been slower, and the cost of output of monetary policy tightening would have been larger. So the change in the Phillips curve, the shifting and steepening of the Phillips curve, that increases or allows monetary policy to bring down inflation at a relatively more favorable cost in terms of lost output. So the inflation output trade-offs that are less strong than with a flatter Phillips curve. Second exercise, the model asks, what are some of the international interlinkages? When we look at monetary policy tightening, if monetary policy tightening is more or less synchronous across countries, how does that affect inflation dynamics? So here we look at US inflation and vary the pace of tightening monetary policy in other countries of the rest of the world. Basically compare what had happened, what would be the counterfactual for US inflation if the rest of the world had tightened monetary policy 3 quarters later. So comparing the observed inflation, the black line, to the actual, to the counterfactual in green, if monetary policy had tightened later in the rest of the world, US inflation would have been higher, driven in particular by the contribution of tradable and price-flexible sectors. Price-flexible sectors, such as agriculture, mining, or energy, where inflation would initially have been higher. Over the time, that would have fed through the production network into inflation, in particular manufacturing, and also some services. And so coordinated tightening expedites the disinflation process because there's a spillover through the prices of tradable goods across countries. Finally, so leaving the COVID episode behind, we do one simulation in the model to try to understand what may happen if we have a different configuration of sectoral shocks, rather than these fairly widespread supply constraints that were binding during parts of the COVID period. What if there are only a few of these sectoral capacity constraints or bottlenecks in energy, food, and mining, all other sectors remaining unconstrained, that are up against a positive an increase in aggregate demand? So the slide's trying to compare how different monetary policy rules may perform. Let me perhaps highlight two. The blue line, which is a policy rule that targets the stickiest prices. You could think of it as a policy rule that targets measures of core inflation. And then the black line, which would be a hypothetical policy role, it puts a 50-50% weight on consumer prices overall and on energy, food, and mining. So a policy rule that would react much more to the inflation in those sectors that are hit by a shock in the simulation. Comparing the performance of the two policy rules, so comparing the blue to the black line, inflation returns to target much faster for the policy rule that targets the stickiest prices. For the central bank that has a higher weight, so the black line, the higher weight on the constrained sectors, initially policy rates are tightened very significantly as inflation in food, energy, and mining rises. But over time, as those prices are very flexible and then come down very quickly, inflation becomes more broad-based in the economy overall. The pace of monetary tightening, where nominal rates have risen, real rates do not rise sufficiently, and so inflation much more persistent if under a monetary policy rule that puts much greater weight on those constrained sectors hit by supply shocks. So the bottom line, in inflation rules or monetary policy rules that target the stickiest price sectors appear to remain appropriate in cases where supply bottlenecks are relatively sparse. So let me perhaps conclude in two steps. One, first taking stock, then some lessons overall. We saw that sectoral shifts amid policy stimulus and capacity constraints characterized these recent inflation dynamics, with a particularly important role for energy shocks and other shocks to headline inflation. That gave rise to a steepening of the empirical Phillips curve. And the chapter then develops a novel model that can account for the transmission of such sectoral shocks into more broad-based or economy-wide inflation. So perhaps three lessons from the chapter. First lesson, so the new lesson, in a situation where supply bottlenecks are relatively widespread, where at the same time there's strong demand, the Phillips curve can steepen and policy tightening can be effective due to a favorable sacrifice ratio of relatively low output cost of bringing down inflation. That may make a case for having well-defined escape clauses in monetary policy frameworks to tackle such inflationary pressures when the Phillips curve steepens, which could as well be internalized in forward guidance frameworks, for example. Second lesson, and sort of confirming an old lesson on monetary policy, in situations where supply bottlenecks are confined only to specific sectors, standard policy rules remain appropriate. And the final lesson from the chapter, overall, maybe need for better understanding of sectoral dynamics. First, through having models, and we've seen more and more of those models being developed in the last couple of years, models that have sectoral linkages and heterogeneity, therefore allow how to study the pass-through of inflation, for example, in a particular sector into the economy more broadly. On the data side, having more granular sectoral data, for example, high-frequency indicators of potential supply constraints that could be informative and could allow to potentially identify some of those supply bottlenecks. Let me stop here, and very much looking forward to Jan's questions and to the questions of the audience and to our discussion.
Yes, so thank you, Thomas. That was very concise, and I think we could review a bit some of the statements that you made, and maybe if I start with the very final conclusion, we're talking about how exactly to do the tightening. So what are the lessons for the tightening policy? Could you expand a bit more? What the monetary policy maker, so to speak, takes away from your study, how to carry out tightening in the future? So what are lessons? Should he first analyze the sectoral constraints that develop, and can you observe them basically in a particular way, and then infer from that how you should design your mix of policy instruments, the speed with which you do it? Or is it not easy to take this lesson from your analysis?
Like, let me perhaps answer it in two steps. In terms of lessons, so when there's sort of more isolated supply shocks across the economy, then monetary policy is a tool that can difficultly address such more isolated disruptions, and that's sort of the conventional lesson that the chapter confirms as well. In situations where these supply bottlenecks may be more widespread, such as what we've seen in some cases during the pandemic, and where there's strong demand at the same time, then the steepening of the Phillips curve can change the trade-offs in terms of bringing down inflation, the relatively more favorable cost in terms of output. Now, for monetary policy, one of the challenges, of course, is always an element of decision-making under uncertainty about some of the key parameters, some of the data that may come with a lag. So developing or going steps into developing potential indicators of supply constraints. Many central banks and other institutions, for example, have surveys of firms, so perhaps adding modules that could target a question that could target more precisely, for example, whether specific sectors could be up against a supply constraint, maybe elements that could inform or could be informative for this decision-making process.
Could you explain a bit more supply constraints? So is this a 0-1 variable or something that has a certain level to it, or is it deeper? Is it also in considering the possibility to substitute certain things, so or to change investment structure or to change organizational setup? I mean, if I think of the supply constraint that we observed after the pandemic or during the pandemic, one major lesson was maybe to diversify your supply chain globally, and so that could help to make things more resilient. Is that something that enters your description of supply constraint, the ease by which you can basically mitigate it?
The model features exactly different elasticities of substitution between different inputs. So basically capturing that, substituting in some inputs may be easier, but substituting, say, energy with services, that does not really work. So the model has those types of elements that are incorporated.
Yeah, I mean, going forward after this experience, industry is adjusting, right? So people will, as I suggested, may diversify their supply chain. So there may be other options available that in the recent past were not available. So when there is such a supply constraint building, it may be much easier to overcome it. And next time is when in a future event that is similar in other respects. So is that somehow captured in the model, or is the model in a way looking backward, taking the constraints as they were and imposing them in the next shock that's happening?
Well, the exercises we show take a step back and look what were the dynamics in terms of some of these sectoral constraints during the pandemic. Yeah. We could use a model to think more broadly, and certainly one of the directions to take it forward, perhaps think around the climate or weather-related events. Climate shock could introduce a capacity constraint in a particular sectors or across sectors, depending on the shock, and then think how other types of shocks, sort of going forward, could affect or how their pass-through would be across a production network.
Yeah, I'm just looking at the Q&A or the chat, no matter where people enter something, but there is only one remark currently, which asks whether your slides are available, whether we can distribute them after your talk.
You can share those a chapter as well that's underlying the presentation, and that has basically not just the charts I presented, but a few more. That one's also publicly available. And your
presentation could also be shared.
We could share that.
So we will distribute that or make it available for those that are attending today. Good. So let me ask a second question that I have. It basically relates more or less to slide 18, where the great tightening is, your analysis of the great tightening is starting. You have this multi-country, multi-sector, new Keynesian model, big machine that you have been developing and applying, basically to better understand how these sectoral supply constraints impact on price development and employment, right? So somehow simultaneously. So my question is whether any effect on changes in investment can also be read out of this model. So can you also make predictions that relate to the response that industry is taking from this shock experience on the investment side, not on the employment side and not on the price setting side, but on the investment side? Could that be read out? Is that part of your model?
It's something that's certainly room to develop the model further. The current setup exactly sort of focuses on the pass-through or the implications of these sectoral constraints on value added. That also then has an impact on the labor market dynamics in different sectors. Certainly another element to grow, and so we want to encourage also certainly more research on this side would be to think more on the investment side and how that may shape some forward-looking decisions of firms as well.
Okay, good. So let me, you have on, there's now a question showing up on this. Let me say. So I just read this from S. Gallon. Do the conclusions hold for the Eurozone where sectoral shock varied across countries and a single monetary policy applied? So can you basically apply your model to Eurozone?
Yeah, taking a step back, and that's what the chapter documents on the empirical side, energy shocks and their pass-through, that was somewhat more important in other advanced economies relative to the US, where the role of a very strong labor market was more important, empirically speaking, in terms of shaping some of the inflation dynamics. The conclusions of the modeling exercise in terms of some of the forward-looking lessons apply to configurations where on one hand there's relatively widespread supply bottlenecks that come up against strong demand pressures. So thinking forward or thinking how the Phillips curve could be in other configurations, if similar configurations or similar types of shocks would occur going forward, those would be situations where if the Phillips curve steepens, trade-offs for monetary policymakers may shift. And so that may apply to different sets of countries if similar types of shocks were to occur.
But does your model take or allow for a number of countries with different constraints that have faced one single monetary policy? That basically is the question. So is the model more just US and the rest of the world?
The current calibration, should be a problem, is currently US and rest of the world, but because it's a difficult to solve model, certainly one direction to take it is to have richer interactions. So, and richer set to have countries, more granular countries that will also allow to study some issues, perhaps around the emerging markets in more detail and more precisely.
So there are technical difficulties in really disintegrating the room in which monetary policy applies to, let's say, different regions that have different constraints.
There's a level of doing exactly work also against our publication deadlines, and so there's one project to take forward as well, and so develop the model further to have richer set. On one hand, broaden the set of countries and country blocks that are covered, and also potentially allowing to study different types of shocks beyond the current the pandemic.
So that is your model mostly speaks about the US. The rest of the world is somehow summarized in some not easy to disintegrate variable, right? Not easy to subdivide variable. Is that correct?
Model features the US and then other countries as the rest of the world in the second block. To the extent that some countries may have experienced similar types of shocks, there may be lessons for those for inflation dynamics and for monetary policy in those cases. Going forward, also on exactly some of the empirical exercises, try to study a richer set to also get and the responses of monetary policy, and the transmission of monetary policy more broadly across advanced economies and emerging markets. In terms of perhaps just the international interactions, what the model allows to study is what was the role of the synchronicity of monetary policy tightening, many central banks tightening at similar points in time, that may have expedited the speed of disinflation as the prices of tradable goods in, for example, manufacturing may have come down faster due to the more synchronous tightening, and that having the effect through aggregate demand.
Yeah, which is a consequence of the fact that these supply constraints are basically global supply constraints, right? And not just local ones. I guess that's why you have this similarity in the policy responses, because the world is highly interconnected on the real side.
Yeah, I think we saw the inflation dynamics that also were fairly synchronized across many countries, with inflation surging and then coming down over relatively similar point in time. And so that then has an implication if monetary policy tightens and reduces aggregate demand in a number of countries, that has an impact through those tradable goods prices that can expedite the speed of disinflation.
Yeah. So to add on this question, I have a question. Says the post-pandemic monetary policy episode was accompanied by significant fiscal policies that varied between blocks. Does your model control for these differences in fiscal responses? So, I mean, it's very clear differences. For instance, the fiscal response during the COVID period, let's say Germany and the rest of other European countries, quite different responses, at least level-wise. Is that part of your model?
The model accounts for a number of cross-country differences, just fiscal, also elements such as significant excess savings in some countries that build up, that may contribute and then feed into aggregate demand. Such factors are incorporated. To get a more precise sense on fiscal policy and do some additional analysis, the chapter has one box that delves more precisely into the fiscal response in particular countries. Chapter that finds that the fiscal response in the euro area, if we do a counterfactual with a weaker fiscal response, that contributed towards somewhat lower inflation. At the same time, there are trade-offs in terms of some of the fiscal measures that we've seen, as they may have a budgetary impact. Some fiscal measures that may run against or counter to climate objectives, and also price support measures that may encourage the consumption by lowering prices of precisely the goods that are up against the supply constraints. So the overall advice that monetary policy remains a primary tool in terms of addressing aggregate demand.
Yeah, so there's currently no further question in the chat, so I have a few further, let's say, drilling down. Maybe we can close the presentation so that it's just the two of us, and we can reopen it when there's a necessity, when you want to show something.
Absolutely.
And so my first question is on slide 14. You speak about peak effects of tightening on consumption prices, and I'm just wondering, as somebody who is not really doing this type of models that you are doing, how you identify the effect of tightening in such models, how you can be sure that this is the tightening and not other aspects, because you basically look at the world in its entirety, the rest of the world, and you don't have 100 different countries that you all look at individually, when identification might be possible because events don't overlap. But here, I can't see that, so I would be interested to understand better.
On a technical level, so we estimate, so just the exact time varying parameter VARs for different sets of countries. The results that we showed covered some advanced economies, such as the US or the Euro area as a currency area, but also some emerging markets, such as India, Brazil, or Mexico. And so basically, the model flexibly allows to identify responses to monetary policy shocks. It's a model that's estimated country by country, and then isolates the effects of just a monetary policy shock then of course we make them
because of the non-synchronity of these different monetary policy measures across a large number of countries.
The model identifies the effect of a monetary policy shock in the respective country. So we estimate the model country by country. I'll say one more for the US, one for the euro area.
But then the identification question is still there, or not. And I don't know how you really identify it. Is it that it's not the supply constraint that hardens at the same moment?
Yes, I think on two elements technically. The model features time-varying parameters, so they also may capture underlying changes in some of the economic relationships that we've observed at this point in time. And that's important, particularly, for example, for the pandemic. We may think that different economic relationships that we saw holding in the past may not have held due to the extraordinary circumstances. And then the responses we show are to a 100 basis point monetary policy shock within each country.
Okay, good. I have one other question on just of understanding on the slides, the previous slides 2 and 12 and 13. You were talking about historical cases, and you had these resolved and unresolved cases. I wasn't really sure that I understand properly what is an unresolved case in a historical context.
Exactly. So for context, we look back at the 1970s, where there were similar types of commodity shocks, particularly around oil prices at that point in time. And then look at episodes where inflation increased initially. We define resolved inflation episodes as those where inflation returns to within 1% of its pre-shock level after a couple of years, and unresolved inflation episodes as those where inflation does not return within 1% of its pre-shock level. So basically, unresolved episodes where inflation was much more persistent and returned to target much slower. The overall finding when comparing to the monetary policy response post-2020 is that the post-2020 response perhaps falls somewhere in between the monetary policy response in those resolved episodes. In resolved episodes, somewhat faster tightening, but in unresolved episodes, somewhat slower tightening than what was observed post-2020.
Could you give some intuition what an unresolved episode is and why is the inflation dynamics maintained or staying high in these cases?
So unresolved inflation episode one where inflation surged back in the 70s but remained elevated or did not return to pre-shock levels within a number of years. We trace it out for 5 years. Well, some potential reasons why that may be the case. One could be through monetary policy and the pace of monetary policy tightening. More broadly, also when we compare the episodes in the 70s to those nowadays or to the post-2020 episode, certainly some important potential differences. For example, around the anchoring of inflation expectations. Inflation expectations were better anchored. The chapter tries to get at that. That may change the room for monetary policy. For example, the chapter delves in more detail. It's difficult to get measures of inflation expectations per se for the 1970s, or at least for a broader set of countries.
You are not recorded that.
But looking, for example, at the volatility of inflation prior to the shocks of the 70s and the pandemic shock, the volatility of inflation was significantly lower in the pre-pandemic episode as compared to the 70s. Right. So perhaps that may suggest better anchored inflation expectations this time around.
Yeah, but is there any real side characterization of unresolved cases? So are these larger structural changes in the working of international markets, let's say, architecture, or do you not think of any such real side explanation for these unresolved cases? Because the unresolved cases are very interesting, very important, right? They basically tell us that the monetary policy was not able to bring inflation back to, let's say, an acceptable level in a certain period.
There's a number of reasons why inflation may have been more persistent. In terms of how we determine them, we determine these episodes around their different inflation path and how those evolved, and certainly the pace of monetary tightening. importance around inflation expectations, keeping those anchored, that may inform some of the dynamics around how long different inflation episodes in the 70s may have lasted.
Okay, so I have one I would say overall question that I had already before I heard your presentation, which is about the robustness of your outcome, your results. My let's say layman understanding is you somehow report a mean let's say scenario that one can think of how the world is moving on, but now we are at a time where things seem to change quite a bit. So we have the election in the US, we have policy events forthcoming in other countries like in Germany, where you all have the feeling that there is a structural shift. Let's say, think of trade policy, for instance, or tariffs being used as a policy instrument on a much larger scale. So are these potential changes already part of your study in some respect, and then how and what were the outcome? Or is that something that now remains to be done in your next report?
So perhaps taking a step back, exactly. So the second chapter one presented here that zooms in on monetary policy. There's a chapter 1 to the World Economic Outlook that touches on the conjunctural outlook and the economic projections on a high level. So the main takeaways in terms of the outlook: stable but somewhat low growth, with medium-term growth prospects that remain somewhat underwhelming by historical standards. Projection towards continuing disinflation, and third, elevated uncertainty. And some of the fan charts, if you take a look at our chapter 1, that try to capture that uncertainty around the outlook that has certainly risen, and that's published 2 weeks ago. Then the outlook delves, for example, relative to the baseline, which has global growth around slightly above 3%, not just this year, but also for the medium term. Downside scenario that tries to simulate different types downsides. So invite to look into more detail. Downside scenarios that look around trade policies, for example, that look potentially at lower migration than advanced economies, and also if the different confluence of factors may lead to a tightening of global financial conditions, that then in that case could also have spillovers and importance for emerging markets.
So if I would be interested in tracing out, in understanding how your projections would be affected in particular scenarios, they are not yet spelled out. You didn't say, well, when we have higher, let's say less world trade, or let's assume this, more inshoring of investment than certain. If we think of the policy agenda that is developing now, is that already in a certain way reflected in particular scenarios that we can read out of your report?
Yeah, so the report of chapter 1 does a downside scenario around.
But downside is one scenario, or is that a set of different aspects?
Downside scenario that comes in different layers. What if there would be perhaps higher tariffs? Then layering
so
uncertainty around trade policy, which adds additional impacts around global GDP on top of just higher tariffs per se, also the uncertainty around trade policy. And then looks at a potential renewal of the Tax Cuts and Jobs Act in the United States. Potential what if there was a scenario with lower migration in advanced economies, and then caps it off with what if there was on top of these factors, there would be a tightening of global financial conditions. So that's exactly in the chapter 1, sort of a model-based analysis. Towards the end of the chapter, very much invite, and also happy to share the details of the chapter 1 that delves into some of those scenarios.
Yeah, so since you shared with us the main points of chapter 1, could you just, like a conclusion to this presentation, give us a glimpse of what is in the third chapter of your report?
Third chapter looks at a very different question. For a number of structural reforms that in some countries have been discussed for a long time. In many cases, implementation of structural reforms can sometimes does not always occur. And so the chapter tries to ask how to build acceptability around structural and social acceptability around structural reforms, with perhaps three key findings. First, highlighting the importance of building consensus across a broad set of stakeholders and doing so early on to potentially improve the social acceptability of structural reforms. Second, introducing and incorporating measures to address the distributional impacts of reforms. And third, a bit relating back to the first lesson, maintaining this continued engagement with a broad set of stakeholders, also over time, to build trust in the process.
Yeah. So I have I think a nice question that we could use as the final question for today. I just read it from the chat. I guess the blunt question is, if inflation would have come down by relaxation of transitory supply side constraints without any monetary response, in particular as inflation expectations seems to have stayed constantly low. So did it really require to loosen and then tighten monetary policy, given the strong, I would say, supply constraint side story that you are telling?
On the side of inflation expectations, so certainly long-term expectations that were very stable across a number of countries. At the same time, we saw short-term expectations initially moving up and then coming down over time again. That's more broadly what the model highlights. When there's this interaction of potential supply constraints that come up against strong demand, inflation can initially surge, and monetary policy can bring inflation down in these circumstances at relatively more favorable costs to output than in circumstances where the Phillips curve is flatter.
Okay, so I have to just ask again, could you, in answering that question, you would say the coming back of inflation would have been slower if you wouldn't have these monetary injections, or what would have been the main result if the monetary policy would have stayed constant?
In the model, we can look at.
So that would be the counterfactual, right?
Exactly, can look at different paths of monetary tightening, what the model of the chapter shows, depending on the path of monetary policy tightening of monetary policy can be effective at bringing inflation down through aggregate demand channels, which in the confluence of factors of number of sectoral supply constraints that act up or that come up against strong demand, brings an environment where bringing down aggregate demand through monetary policy tightening can be relatively effective in terms of lower costs of foregone output as compared to other types of configurations.
Which would imply the one that the question implies, namely that there is no response, right? If there wouldn't have been any response, so that would have had basically welfare costs. Well, that's how I understand your answer. Is that I hope that captures.
Yeah, monetary policy in the model by reducing aggregate demand. And that's the main channel that helps bringing inflation down. And then, as we discussed, supply bottlenecks and so sectors up at their capacity constraints can facilitate the disinflation process, as inflation in those sectors that are up against a capacity constraint comes down more quickly or at a very moderate, more moderate cost to output, driven by those sectors that are up against the supply constraints.
Okay, good. So, Thomas, thank you very much for answering all these questions. And thank you to the audience for staying with us for this hour of inspection or of learning on this new IMF report. Thank you for coming here, and I look forward to your next exercise, which will probably be in a year time. Is that more or less the same time where you will publish next World Economic Outlook?
So World Economic Outlook comes out twice a year. The next one will be in April, and there will be an update that will focus on conjunctural predictions in January already.
Wonderful. So then see you again then. See you again. Thank you very much for joining, and have a good day.
Thank you very much, everybody, for joining.